There is a mathematical flaw hidden deep inside the strategy of almost every dividend investor watching this. You have been told that immediate, automatic reinvestment is the only engine of compounding. We treat time in the market as a religious doctrine that cannot be questioned. The industry tells you that keeping any cash on the sidelines is a sin against your future wealth. But this blind devotion to full reinvestment creates an invisible ceiling on your portfolio's potential. By buying shares automatically, regardless of price, you are often purchasing expensive assets that drag down your yield. Imagine if you could mathematically guarantee that a portion of your capital would only be deployed when yields are at their absolute peak. This is not about timing the market, but pricing it. Most investors are satisfied with average market returns because they value comfort over optimization. They click a button, the dividends reinvest, and they feel productive. But comfort is the enemy of acceleration. Today, we are going to dismantle the 100% reinvestment myth. We are going to replace it with a strategy that sacrifices a fraction of immediate compounding to build a massive tactical advantage. This is the 10% cash flow rule. It is a slight adjustment to your monthly workflow that creates a liquidity buffer capable of capturing generational wealth during market corrections without selling shares. My name is Dave. Welcome to the lab. If you want math, not hype, like this video now. Let me ask you, what percentage of your portfolio is sitting in cash right now? Comment your number below. Let's begin by challenging the conventional wisdom that every dollar of passive income must immediately buy more shares. This is the drip mentality, and while it builds wealth, it is painfully slow. When you reinvest dividends automatically, you are a price-insensitive buyer. You are telling the market that you do not care about valuation, price-to-earnings ratios, or historical highs. You just want more shares. This works in a flat market, but it is inefficient during a bull run. When the Standard & Poor's 500 is trading at all-time highs, your reinvested dividends are buying less value for every dollar. The traditional dividend reinvestment plan is a defensive strategy designed for people who do not want to look at charts. It protects you from your own psychology, but it limits your upside. We need to shift your mindset from accumulation at any cost to strategic accumulation. The goal is not just to own more shares, but to own more shares that produce higher yields. This is where the liquidity trap becomes apparent. If you are 100% invested at all times, you have zero maneuverability when the market presents a rare, high-yield opportunity during a sudden downturn. Market downturns are the only times when high-quality assets go on sale. If your money is tied up in automatic reinvestment, you can only watch these opportunities pass you by from the sidelines. Some will argue that cash is trash due to inflation. They say that leaving money uninvested is losing purchasing power. In a vacuum, this is true, but we are not operating in a vacuum. We are operating in a volatile market environment. The purchasing power lost to inflation on a small cash position is negligible compared to the capital gains made by buying a 20% dip. This brings us to the concept of strategic liquidity. This is not hoarding cash out of fear. It is accumulating a precision weapon to deploy when the market creates a dislocation. The 10% cash flow rule acts as this mechanism. It does not stop your compounding. It simply redirects a small stream of it into a reservoir that you control completely. Think of your portfolio as a business. No successful business reinvests 100% of its profits into inventory immediately. They keep cash reserves for acquisitions, emergencies, and strategic pivots when competitors are weak. By following the herd and reinvesting everything, you are stripping your business of its ability to react. You become a passenger in the market vehicle, rather than the driver of your returns. The math supports this approach. While continuous compounding is powerful, step function growth, where you make massive purchases at bottom valuations, can outperform smooth compounding over a 10 or 20-year investment horizon. We are moving away from the passive accumulation model. We are entering the active management phase of the dividend lab. This requires more discipline, but the payoff is a significantly lower cost basis. The fear of missing out on a few days of market gains often paralyzes investors. They worry that if they hold cash, the market will run away from them forever. But history shows us that volatility is a guarantee. Markets do not go up in a straight line. By having no cash, you are essentially betting that a correction will never happen again. That is a statistically losing bet. Corrections happen. Recessions happen. Panic happens. The 10% rule prepares you to profit from the panic rather than being a victim of it like everyone else. So, we have established that full reinvestment is a suboptimal strategy for the aggressive investor. It is safe, it is easy, but it leaves too much money on the table for us. Now, let's look at the mechanics. How do we actually build this buffer without disrupting the compounding effect that we all love? It starts with the specific allocation of your monthly income. The rule is simple. For every $1,000 of dividends you receive, $900 goes into your standard reinvestment plan. But $100 is diverted immediately into a high-yield account. This 10% diversion is the sweet spot. It is small enough that you will not feel a drag on your monthly compounding, but large enough to build a substantial war chest over time. Let's calculate the impact. If you yield 4% annually, diverting 10% of that yield reduces your effective reinvestment rate to 3.6%. The difference is almost imperceptible. However, that accumulated cash grows distinct from your equity volatility. It becomes a stable anchor. While your stocks fluctuate wildly, your dry powder fund moves only in one direction, up. You must set up an automated system for this. Do not rely on your willpower to separate the funds. Create an automatic transfer that triggers the day your dividends hit your brokerage account. This separation is psychological as much as it is financial. When you see that cash balance growing, you stop fearing market drops. In fact, you begin to secretly hope for them. The 10% rule transforms your relationship with red days. When the market bleeds, the fully reinvested investor feels pain. The investor with a cash buffer feels a surge of excitement. We are minimizing the impact on current compound growth to maximize future purchasing power. You are trading pennies of yield today for dollars of equity growth during the next major market correction. Considere os juros que você ganha sobre esse buffer de caixa. Com as taxas atuais, seu dinheiro de espera ainda está gerando um retorno. Não é dinheiro morto, é uma força de reserva. The accumulation phase requires patience. You might go 6 months or a year without deploying this cash. That is fine. The longer you wait, the larger your advantage becomes when the time comes. Do not touch this fund for regular expenses. It is not an emergency fund for your life. It is an emergency fund for your portfolio. It has one purpose: buying high-quality assets cheap. As the fund grows, it becomes a significant percentage of your net worth. Eventually, you will have enough cash to buy entire positions in new companies without selling a single existing share. This is the definition of optionality. You are no longer forced to take whatever price the market offers on your dividend payment date. You hold the power to dictate your entry price. The discipline required here sets you apart from the retail crowd. Most people cannot stand seeing cash sit idle. They feel the itch to buy something, anything, just to feel active. You must resist that itch. Your cash is an asset class. It is a call option on future volatility with no expiration date. Treat it with the same respect you treat stocks. By the time you have practiced this for a year, you will see the logic clearly. Your dividend income continues to rise, but your ability to strike at opportunities has exploded exponentially. Now, how do we deploy this? We do not guess. We use data. We look at the market environment in 2026 and identify the specific signals for deployment. We are looking for key indicators in market data that signal high-quality asset price reductions. We are not looking for a 2% dip. We are hunting for corrections of 10%. When a blue-chip dividend king drops 15% due to temporary bad news, that is your signal. The fully reinvested investor buys a fraction of a share. You buy 100 shares. This is where the math of the 10% rule shines. You are utilizing the accumulated cash buffer to purchase undervalued equities without selling your existing long-term holdings and triggering taxes. Selling existing assets to buy a dip is inefficient. You trigger capital gains taxes, you pay transaction fees, and you reset your compounding clock. Buying with cash avoids all of this friction. The efficiency of new money entering the market is always higher than recycled money. Your cash buffer represents the purest form of new capital, ready to capture the highest possible yield on cost. Let's analyze the psychology of 2026. Volatility is increasing. Algorithms drive prices down faster than ever before. Flash crashes create windows of opportunity that may only last for hours. If you do not have cash ready, you cannot participate in a flash crash. By the time you transfer money from your bank, the opportunity is gone. Your buffer must be instant. Timing the market is impossible, but timing value is necessary. You are not predicting when the crash happens. You are simply reacting to the price tag the market places on your assets. Think of this as targeted averaging. Instead of dollar cost averaging blindly, you are value averaging. You buy more when the price is low and less when the price is high, automatically. The 10% rule forces you to be a contrarian. You are buying when everyone else is selling. This is the only way to achieve superior returns. You cannot beat the market by mimicking it. Why does this outperform selling assets? Because you keep your core compounders working. You never interrupt the compounding of your original portfolio. You simply supercharge it with an external injection of liquidity. The recovery phase is where you win. When the market rebounds, the assets you bought at a 20% discount recover faster and yield higher than the rest of your portfolio. This lowers your average cost basis significantly. A lower cost basis means a higher margin of safety and a higher yield on cost forever. This is a permanent advantage locked into your portfolio. Now let's compare the growth trajectories. We need to visualize the difference between the tortoise of 100% reinvestment and the snapping turtle of the 10% cash flow rule. Investor A reinvests everything. His portfolio grows smoothly. It tracks the market index. He feels safe, but his yield on cost creeps up slowly because he buys at market peaks constantly. Investor B uses the 10% rule. His portfolio lags slightly in the first quiet year. But in year 2, a correction hits. He deploys his cash buffer at the market bottom. When the market recovers, Investor B's portfolio value overtakes Investor A. The shares purchased at the bottom appreciate 50% in the recovery, while Investor A's shares merely return to their previous value. This creates a gap up on the chart. Every major correction widens the gap between the two strategies. Over 10 years, Investor B owns significantly more shares and generates significantly more income. Let's demonstrate how opportunistic purchases accelerate capital appreciation. Buying a stock with a 4% yield that drops to a 6% yield locks in that 6% income stream forever. Investor A, buying automatically, averages a 4% yield. Investor B, buying strategically, averages a 5 or 5.5% yield on his new capital. That difference compounds massively over time. Real-world examples prove this. Look at the COVID crash of 2020. Investors with cash buffers who bought in March 2020 doubled their money by 2021. Fully invested investors simply recovered losses. The difference between recovering and doubling is liquidity. Liquidity is the oxygen of the financial markets. If you have it when others don't, you dictate the terms of the transaction. This strategy also reduces portfolio beta. By holding 10% of your flow in cash, you dampen the overall volatility of your account. You sleep better knowing you have a cushion against disaster. The critics will say this is too much work. They say they don't have time to watch the market. But you don't need to watch the market daily. You set price alerts. When a target stock hits your price, your phone buzzes. You log in, you deploy your cash, you log out. It takes 5 minutes of work to secure years of accelerated returns. Comparing the final portfolio values, The 10% strategy often results in a portfolio that is 15 to 20% larger after 2 market cycles. That is the cost of convenience. Now let's talk about implementing this for 2026 and beyond. You need to take action today. You cannot wait for the crash to start saving. You must prepare now. First, audit your current portfolio yield. Calculate exactly how much cash flow you receive monthly. Multiply that number by 0.10. That is your new monthly transfer target for liquidity. Establish the workflow immediately. Log into your brokerage. Turn off the automatic drip for your largest positions if necessary, or simply set up an auto deposit from your checking account to match the amount. Next, define your discipline parameters. You must write down the rules. I will not deploy this cash unless the index drops 10% or a target stock drops 15% below fair value. If you do not define the rules, you will be tempted to use the cash for minor dips. You must be disciplined. You are a sniper, not a machine gunner. Wait for the perfect shot. You also need a reaccumulation plan. Once you deploy the cash, the bucket is empty. You must immediately restart the 10% diversion to refill the tank for the next opportunity. This creates a cyclical engine of wealth. Fill the bucket, wait for the crash, empty the bucket, ride the recovery, repeat. This is how the smart money operates on Wall Street. Do not worry if your cash balance gets too high. If the market goes 3 years without a correction, your cash pile will be huge. That just means your eventual buying power is massive. There is no such thing as too much cash when a bear market hits. In a recession, cash is king. The person with the liquidity buffer is the only one smiling. This strategy forces you to become a student of valuation. You stop looking at stock prices and start looking at business values. It matures you as an investor and sharpens your analytical skills. We are transforming passive income into an active engine for accelerated wealth accumulation. You are no longer just a collector of dividends. You are an allocator of capital. That is a CEO mindset. The 10% cash flow rule is not for everyone. It is for those who are willing to delay a tiny fraction of gratification today for a massive strategic advantage tomorrow. It is for the investor who understands that the market is a tool to be used, not a master to be obeyed. It puts the control back in your hands. Start small if you have to. Try it with 5% if 10% scares you. But start building that buffer. The next market correction is coming. It is a mathematical certainty. When it arrives, will you be the victim watching your portfolio value vanish? Or will you be the predator, stepping in to buy the assets of the fearful at pennies on the dollar? The choice is yours. The math is clear. The strategy is proven. The only variable left in this equation is your willingness to execute it with discipline and consistency over the long haul. Look at your portfolio today. Look at your cash. If the number is 0, you are vulnerable. Fix it. Divert the flow. Build the wall. Prepare for the opportunity that changes everything. Remember, the goal is not just to retire. The goal is to retire with abundance and security. A fully reinvested portfolio gets you there. A strategic portfolio gets you there faster. Stop following the herd off the cliff of overvaluation. Be the outlier. Be the contrarian. Be the investor who welcomes the red days because you prepared for them while everyone else was celebrating. This is the Dave's Dividend Lab way. We analyze, we optimize, and we execute. We do not hope for wealth. We engineer it through superior mathematics and unbreakable psychological discipline. Thank you for watching. If this strategy opened your eyes, share this video with a friend who blindly reinvests. Wake them up. Let's build a community of strategic capital allocators. Check your cash balance. Make the plan. Execute the rule. I'll see you in the next video with more strategies to optimize your financial future. Class dismissed.